Good afternoon. Am I audible? Okay, great. Thank you. So it is very difficult to do any session before lunch actually or after lunch actually. So I'll not take much of the time. But this is a very important area which I think we need to discuss. And all the CFOs are here and the people who are from the finance. And you see, startup is the buzzword in the current scenario. India is leading in many ways in the startup ecosystem. And in every family, you will find, I think, one member of the family is doing a startup, or if it's not doing, and will do surely uh, after some time. Or so, what is happening actually? Startup. Uh, we have large ecosystem of the startups in the country. So you see that whenever anybody is starting the startup, he's trying to put his money, his parents' money or his relatives' money, and then after reaching to a certain stage, uh, they are looking for funding from the investor or the VC funds, angel funds. And you see that angel fund and VC fund, private equity fund, they are the people who are basically raising money from the different market, from the different investors, and they are putting money again in the startups and the other companies actually. So in India, I'll just run through that this thing journey of the investments in India in the startup ecosystem. So if you see, the last year, almost $25 billion invested in the startup ecosystem, almost 2 lakh crore were invested by the various VC funds and the angel funds in the startup ecosystem. And the more than, I think, 1,000 of startups were funded actually. So this number is less last year, but before that it was very high actually. And mega deals, 60 mega deals, and the average deal size was something around 150 crore. M&A, there were almost 250 or 240 M&A deals were there. And you see that Delhi NCR got the major advantage in the M&A deals. And e-commerce was on the top in the M&A side. Unicorns, so last year we have more than 100 unicorns now, and last year we made 21 unicorns. And major unicorns came from the Bangalore side. And the overall unicorn valuation is something around $27 billion actually. It's a huge valuation, and we are the third largest country in the world in terms of number of unicorns. So China and US is there, and the third is India actually. So this is the flow of fund in the last 7-8 years in the Indian startup ecosystem. If you see that in terms of number of deals and the flow of fund, the 2021 was the year where we got the highest valuation, highest amount of the money from the investor from across the markets, from across sectors also. But in 2022, it goes down actually. So we are talking funding winter and all. So there is a change in the mindset of the investors. They are more focused on the profitable companies or profitable startups and all. So it is taking time to get the kind of volume which we got in 2021. But I'm quite confident that in this year, 2023, we'll surpass this number, the $42 billion actually. And we see in the coming years, the growth will come also in that investment side. So the topic is the key consideration for the investment by any VC fund in the startup ecosystem. So we see whenever we have to raise funding, we have to approach to the VC funds and what they look for actually. So the major area which they are generally focusing on the management side. So the people who are running so basically the founders. So it is very important whenever anybody is going for raising funding, we have the concerned founders should have the relevant experience. That is very important actually, and the commitment. Because we as Resurgent India, we are helping the startups in many ways in terms of funding and the other areas of advisory also. So what we have seen, the commitment level is not there in many cases where the founder is doing 2-3 businesses actually, and when they are going to raise money, and this creates problem actually when the funds are asking, the VC funds are asking that what are you doing, and if you are doing 2-3 things simultaneously, then definitely your commitment will be diluted. So this is one of the aspects which need to be kept in mind actually. And then the business, robustness of the business actually. So whatever the model or whatever the problem which you are giving the solution, there should be the large customer base. May not be today, but it should be highly scalable. That is very, very important. And as I told, that funding winter which we are talking, the cash flows and all the profitability is the most important thing in nowadays. So if you are burning a lot actually in terms of your unit economics is not working, then definitely the funding might be difficult for you. A satellite model it is one of the key ingredients for raising any funding from the BC funds. So you should not be asset heavy actually. So the businesses which are the brick and mortar businesses and they are having a lot of investments on the inventory or the working capital, the investors are not appreciating it actually. So we need to keep in mind that our model should be like that, where the less investment should go in the assets, either in the fixed assets or the working capital assets. The most of the money should go the scaling of the business actually. So that is very important. The third area is the growth prospect. Who are your competitor actually? That is very important. Before reaching to any investor, we should know as a founder or a management team that who is our competition, and which are the player, and what are their numbers also, financial numbers and the other numbers. Otherwise, it will be very difficult for you to convince these people, because they are having a lot of database with them before talking to any of the company or any of the startup founder actually. And you see that industry outlook again, the industry in which you are working, whether regulatory issues are there. It is very important actually. Whether you are supplying to the government, so whenever any startup is supplying to the government, or the government revenue is there in that organization, or major revenue is coming from the government supply, and all the investors are not betting on these organizations or these companies actually. Regulatory, whether it is a highly regulated area where you are working. So these things need to be kept in mind before talking to any fund. Then this is also an important area, utilization of fund. Whatever the funds you are raising, how you will utilize actually. Many times the people are not in a position to give the complete information in the bits and pieces, how these funds will be utilized actually. So it is like that whenever you have some money and you are investing in any organization, how you will utilize these money, you have to have that understanding, and you should be in a position to describe to the fund that how this money will be utilized, and when it will be utilized, and basically it will go in the right kind of investment also. So this is also very important area. We should know in advance that how the money will be utilized in our business, and we should have the capital to for some time of the burning of the whatever the cash flows are there. So it should not be like that when we are reaching to the fund and we are at the verge of the zero cash flow or the very less cash flows actually. This will not be appreciated also. And the exit route, so any investment which is coming in any startup or any company, the first question is actually exit route actually. Although the investor will not ask this first question, but the first question in his mind is always that how he will exit actually. So there are 4-5 areas of exit which need to be discussed well in advance within the founders or with your advisors who are advising the startup, that what can be the areas where we'll give the exit to the investor actually. So IPO is one of the area, but there can be secondary sale, so there can be larger investor can come. Strategic, a lot of startups are now doing strategic sale of their equity, because you see that many large organizations, those are into different businesses, they are seeing some kind of synergy with these startups. So the investors are also discussing upfront whether this can be a strategic sale of this organization or this money, the equity which they have put actually. So there are many funds those are investing at the initial stage, and they are taking to that start of the next stage, and then they are selling it to the large organization actually. So we need to see that what is the mindset of the fund also, and what is our mindset, and how this can be done also. Then the process of raising of BC fund or private equity fund, that is very, very important, when we should be well prepared before raising any funding. So we need to have the right kind of business plan, and all the areas which I have discussed earlier, the ingredients of the business plan in terms of the founders, your business competition, and the product, all areas are to be covered in that business plan. So we called it information deck or pitch deck, which need to be prepared. Many times we have seen that the founders are very passionate about their business, but they are not in a position to generate the right kind of business plan which the investors understand. So the startups, founders, or anybody who is looking to raise fund, they should take the help of the advisors or the consultant who are expert in this area, where the right kind of business plan should be ready before reaching to the any investor. So doesn't make any difference at what stage you are actually. You can be at the seed stage, or you can be at the angel stage, or you can be series A, series B, but business plan should be ready for all stage actually. So that is very, very important. The financial model actually, because these all investors are having the financial background, so they understand the financial number, and they want to see that the founders knows about the financials or not actually, and how do they see their organization in next 5 years or 7 years actually. So the financial model should also be ready in advance, and where all the revenue numbers, all the expenses, all the investment, everything should be covered in such a manner where it should be achievable actually. We should not be talking any nonsense, because otherwise what will happen, the investors will not give you value for that discussion actually. The industry analysis, it is a part of that the pitch deck and your financial this business model actually. And the one more area is the valuation actually. So before talking to any investor, we should know our valuation, what is our valuation actually. That is another area where many people are lacking actually, and we are seeing the difference. There are multiple times of difference in the valuation expectation and the valuation which the investors can give and what they are thinking actually. So this is a very important area where any of you are looking to raise fund from the VC fund, you should do a lot of hard work on the valuation side, either through the consultants who are expert in the valuation, or your advisors who are part of your organization. So you should, there are many ingredients for the valuation. What is the DCF valuation? We called it basically a discounted cash flow based method, where we have the 5-7 years number, and then we have to discount it and see that what can be the valuation. Then the peer group valuation, that is also important, and many times we are not seeing the peer group, that how the peer group are basically valued and all. And then we have to see the size of the peer group also. Sometime what is happening, any e-commerce startup is starting, and they are talking that my valuation should be like the Flipkart or the Amazon and all basically. So it will not happen like that. So this is again I think big difference in the understanding. Whenever anybody raising fund, it is creating a lot of I think differences between the investors and the startup founder when they are talking about the valuation. So this is another area which need to be taken care well in advance. Then the identification of investor, I think that is the very important area, where how you will know that who is the right investor for your organization. Like investor is looking the right kind of a startup, you have to have the understanding that, so there are thousands of funds are there actually. There are different government funds are there, the corporates are there, they started their family office hedge funds. There are BC fund, those are domestic funds and international funds. So we have to have this kind of knowledge, or we don't have the knowledge, then we have to engage the organization like Resurgent India, or there are many other organizations. Those are helping, or those are having the complete database of the investors, that who all are the investors across. Then the investors are also having the mandate of investing in different kind of sectors or different kind of stages, whatever the money they are investing. So we have to see that out of, suppose there are 1,000 investors who are there in the overall pie, how many are there, suppose you are in a health tech space actually, just for example. So how many are there, those are looking to invest in the health tech space actually. So the investors are having their mandate, very clear mandate, that they want to invest only in these sectors. So otherwise what will happen, you will approach to the entire universe and you will not get anything, because your energy will go waste. So we have to have the understanding that which are the investors who are investing in the health tech or whatever fintech or whatever the other area is there basically. Then the size of the investment or the stage of the investment actually. Suppose you are looking $5 million investment. So $5 million investment, there are investors who are having the investment in the bracket of $1 to $10 million maybe. So you have to have that, these investors you have to approach actually. Otherwise, what will happen, the other investor will not value you. So, and you have to see that what kind of investments they have done also. So this is an preparation which we need to be, which we have to do in advance, and this will help you to get the right kind of investor at the right valuation at the right time also. Otherwise, your time will go waste actually in all these efforts actually. Then the negotiation, I think this is an art actually. It's not dependent on that whatever has been written on the paper actually. So negotiation is again based on various parameters, various areas are there where we have to have the right kind of negotiation with the. So we have to have the understanding of the market, that uh, 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 what are the investments in the past in the different areas or different sector by the different investors, and what are their valuations, and practically whether it has gone up and it has gone down. Because in this current scenario, what is happening actually, many of the startups, those have raised fund earlier at the higher valuation. Now they are raising fund at the lower valuation because of maybe they are burning a lot of money actually, or they have won a lot of money. They are not getting traction from the scalability point of view. So we have to be very, very realistic about that actually. Otherwise, what will happen? This negotiation exercise which we are doing with the investor, it can go any way actually, where the interest of the investor may lose also. Then the due diligence, so this is part of the process of the investment, where any investor is investing, they are doing these three kind of minimum due diligence, where either they are doing through the third party or they have some internal team. So the legal, where what is happening actually, there are many areas are there, many startups are there. They have failed in the legal due diligence actually, because they are focusing on the business and they are not seeing the right kind of contract should be there, what kind of no, there should not be any hanky-panky thing in the organization also. So there is a latest example called Go Mechanic actually, where the lot of investors have lost money actually. So now investors are also now more, I think, careful before investing, that these due diligence should be very, very, very strict. And if anything is there in the due diligence, I think they are not very much interested in these organizations, or you have to compromise on various things whenever anything wrong is there in these due diligence actually. So these three areas of due diligence are there, where uh, at least we should have some kind of understanding before going to any funding. Then the closure, so closure again, the agreements and all, so there are a lot of closures are there. So there are legal firms are there, then the investment bankers are there. Those are helping that what should be the clauses for the exit or the second round of investment, and other right to the investor, right to the founders and all, which need to be I think kept in mind, or we should understand all these things. So this is all from my side actually. I've just tried to cover up that whenever any startup is raising fund, how they can be prepared themselves so that they can get the funding at the right time or the right valuation from their investors actually.